Welcome to Sheen Research, your strategic partner in comprehensive investment analysis. Today, we are looking at one of the most interesting stories in retail right now, Albertsons companies, or ACI. Specifically, we're digging into their performance for the second quarter of fiscal 2025, which ended back on September 6th. And, the context here is just everything. The massive Kroger merger is off the table, and ACI is now pushing forward with its standalone strategy, what they're calling the New Day at Albertsons.
Right, and that New Day narrative really hangs on two major ideas. One is accelerated digital investment, and the other, and this is critical, is a huge immediate return of capital to shareholders. So our mission today is to really get into the recent 10Q filing, all the management commentary, and figure out the trade-offs they're intentionally making. Are they giving up short-term margin for long-term volume?
And can their productivity plans actually bridge that gap? Okay, let's unpack this. We have to start with the headline financial figures. Top-line revenue looks solid. Net sales and other revenue, they grew 2.0% year over year, hitting $18,915.8 million. That's up from about $18.5 billion last year.
It's solid growth, but the real operational story, as always, is in the identical sales figure, excluding fuel.
Right.
And that number, identical sales, was up 2.2%. But what's really fascinating is that even that number was, let's say, artificially low.
How so?
Management pointed out that the figure was negatively impacted by 12 basis points because of a 3-week labor dispute in Colorado. It affected about 47 stores.
So they're basically saying, hey, ignore this little hiccup. The underlying performance was actually a bit stronger.
That's the message. So if we look past those temporary headwinds, you have to ask what was really driving that 2.2% growth.
And what was it?
It was almost entirely the pharmacy business.
Yeah.
Pharmacy sales surged by an impressive 19% year over year in Q2.
Yeah. 19%. That's a huge jump.
Yeah.
But wait, doesn't selling more prescriptions usually, dilute the core grocery margin?
Yes, and that is the central tension of this whole story. They're generating massive growth in a segment that just operates at a structurally lower margin profile.
So they are trading profit for volume.
It certainly looks that way, and you can see that pressure as soon as you move down the income statement.
Okay, so let's go there. Profitability. The picture gets a little complex when you compare GAAP to the adjusted figures. GAAP net income was $168.5 million. That's up from $145.5 million last year, which gave them a basic GAAP EPS of $0.30 compared to $0.25 the prior year.
Looks great on the surface.
It does, until you peel back the layers. That GAAP improvement is largely due to some, let's call it financial cleanup, which we can get to. But operationally, adjusted net income actually declined. It dropped to $248.4 million from about $301 million last year.
I see. And what did that do to the adjusted earnings per share? Adjusted EPS came in at $0.44 per diluted share. And look, while that did beat the consensus estimate by 4 cents, you're still comparing it to $0.51 last year.
So that margin erosion is very clear. And I'm guessing it shows up in EBITDA too.
It absolutely does. Adjusted EBITDA, which is, a key measure of operational health, declined 6% to $848.4 million.
And as a percentage of sales.
That's where you really see it. Their adjusted EBITDA margin compressed pretty significantly, falling from 4.9% of sales last year all the way down to 4.5% this quarter.
So why the sharp drop? This brings us back to that strategic choice, doesn't it?
Directly back. The gross margin rate decreased to 27.0% in Q2 compared to 27.6% a year ago.
And if we normalize that, take out the volatile stuff like fuel and LIFO expense, how big was the drop in the core margin?
Excluding fuel and LIFO, the rate decreased by 63 basis points, and it's directly attributable to their two big growth areas, pharmacy and digital. The strong, low-margin growth in those two, plus the rising costs of delivery and handling for digital orders. That's the cost of buying market share right now.
You mentioned LIFO expense. Can you just give a quick takeaway on that for our listeners?
Sure. LIFO is just an accounting method, last in, first out. It assumes you sell your newest and usually most expensive inventory first. So in an inflationary world, it makes your cost of goods sold look higher, which pushes down your reported profit. The Q2 LIFO expense was $11.0 million, more than double the $4.8 million last year.
Which just shows how much higher inventory costs are hitting their P&L.
Exactly. More pressure on that gross margin.
Okay, so they're facing all this pressure, but it looks like management is making some real headway on cost control, specifically with selling and administrative expenses.
They are. This is the other side of the coin, the crucial counter-narrative. S&A expenses as a percentage of sales actually decreased from 25.8% down to 25.4%.
That's pretty significant leverage.
It is. If you strip out fuel, their S&A leverage improved by 50 basis points.
And what drove that improvement?
A couple things. The big one was just leveraging employee costs across higher sales. But honestly, the biggest driver was the drop in merger-related costs.
Ah, so no more massive legal bills for the Kroger deal.
Exactly. That created a huge one-time benefit that helped offset the new costs they have for their own internal business transformation. They're basically taking money they would have paid lawyers and putting it back into the business.
That makes sense. Let's talk about some of the non-operating items that really boosted the Q2 results, because it feels like ACI spent the quarter doing a lot of financial house cleaning.
They absolutely did. ACI really cleaned up its balance sheet. If you remember, last year they took this big, painful write-down on some failed experiments.
You mean those experimental robot warehouses they were testing? The micro-fulfillment centers?
Those are the ones. Last year's Q2 included a massive $43.9 million loss on property impairments. And almost all of that, $39.8 million, was from shutting those down.
So they basically said, that didn't work, took the loss, and moved on.
Right. This year, the impairment loss was only $4.4 million. Just having that comparison provided a huge cleanup boost to the GAAP financials.
And there was a pension benefit too, wasn't there?
There was. A pretty notable one. They recognized a $26.8 million pension settlement gain. It was a massive contributor to the other income line. Now, these aren't recurring operational gains, but they definitely improved the GAAP bottom line, and they signal some financial prudence.
Okay, let's move past the numbers and into the strategy itself, the Customers for Life plan. Because as you said, the profitability strain is the cost of doing this, so we need to see if the growth is worth the pain. Let's start with digital.
The digital story is really strong and, more importantly, consistent. Digital sales were up 23% year over year.
Wow.
And what's interesting is that's right in line with their 3-year compounded annual growth rate. So this isn't a one-off spike. They also reported that digital grocery penetration is now well above 9%.
And what are they doing to make that digital experience stickier for customers?
It's about reducing friction. They mentioned a new conversational search feature in their app called Ask AI. It's a small detail, but it shows a deeper commitment to using AI to make shopping easier.
But let me push back on that a little. Digital growth of 23% is expensive. Can ACI really keep this up without those delivery and handling costs just eating away more and more of their margin?
That is the multi-billion-dollar question, and their answer seems to be leveraging their massive loyalty base.
Okay.
The loyalty program is directly tied to digital success. Membership is soaring up 13% year over year to 48.7 million members. The strategy is simple. More data means more efficient targeting, which means less promotional spending.
And they're getting creative, expanding that loyalty proposition beyond just groceries.
Precisely. They launched For You Travel, which is powered by Expedia. Members can earn cash back on travel that they can then spend on groceries. It's a really smart move to deepen engagement and make it harder for customers to leave.
Okay, let's go back to that 19% pharmacy growth. What's driving that, and why are they so focused on it if it's a low-margin business?
Two main things. First, the market itself is just booming, mostly fueled by the growth in GLP-1 weight loss drugs. Second, ACI is actively capturing market share from competitor closures. Management sees pharmacy not just as revenue, but as a way to get high-value cross-shoppers in the door. Those customers spend a lot more in the rest of the store.
So to counter that margin pressure from digital and pharmacy, they have to be boosting margins somewhere else. That brings us to owned brands, their private label stuff.
Owned brands are the ultimate margin offset. They're trying to drive penetration from 25% up to 30% over time. These private label products have much higher margins than national brands, and they're a huge value proposition for price-sensitive customers. This is what gives them the flexibility to invest in price in other areas.
And none of this works unless they're running a super tight ship. What's the progress on the operational productivity side?
It's a massive campaign. They're targeting $1.5 billion in savings between fiscal 2025 and 2027. And they confirm they're on track for this year's target. It's everything from inventory management to supply chain.
And we also saw some changes to their physical store footprint.
Right, asset optimization.
Yeah.
They closed 29 underperforming stores so far this year, just weeding out the dead wood. But crucially, They still plan to open 9 new stores by year-end, which signals they're still focused on targeted, profitable growth.
And finally, a huge operational win that removes a lot of uncertainty: labor.
Absolutely. Think about it, settling contracts for 107,000 workers. They successfully reached agreements covering the vast majority of associates up for renewal this year. That removes a massive, unpredictable risk and gives them a clear labor cost structure going forward.
Let's switch gears to capital allocation, because this is where ACI really showed its conviction after the merger fell apart. They announced a really dramatic, aggressive return of capital.
This is where things get really interesting. The board increased the share repurchase program from $2 billion up to $2.75 billion. And they didn't wait. They immediately executed a $750 million accelerated share repurchase, an ASR.
They basically said the stock was underappreciated. Is this a genuine conviction buy, or is this management maybe overcompensating? They lost the buyout, and now they have to placate shareholders who are counting on that deal.
It's probably a mix of both. But you don't execute a $750 million ASR unless you really believe your stock is mispriced. And remember, year to date, they had already bought back 25.7 million shares for $550 million. So even after this ASR, they still have $1.3 billion left on the authorization. They are betting big on themselves.
How does all this affect their balance sheet? Are they taking on too much leverage?
Management says the net debt to adjusted EBITDA ratio will be around 2.2 times after the ASR. That's a very manageable level for a company like this. It gives them plenty of flexibility.
And they made some moves on the debt side, too.
A very smart refinancing. They basically did a debt swap. They retired $600 million of expensive 7.5% debt and replaced it with cheaper 6.25% notes. It's a subtle way to cut long-term interest costs. They also extended the maturity on their main credit facility out to 2030.
We also saw them raise their capital expenditure guidance, which ties directly into that digital and automation push.
Yeah, they bumped the low end of the CapEx range up, so now it's $1.8 to $1.9 billion. This reflects that accelerated investment they need to fuel the digital growth and fix their operations. They're investing in the future and returning cash to shareholders today.
So let's look ahead. What did they say in their updated guidance for the full fiscal year 2025?
Well, that ASR definitely helps sweeten the outlook. They raised the low end of their identical sales growth guidance, so now they're expecting 2.2% to 2.75% for the year. That's a sign of confidence. Adjusted EBITDA guidance, though, remained unchanged at $3.8 to $3.9 billion, which tells you they still expect margin pressure.
But the EPS guidance went up.
It did, but that's entirely because of the share reduction. The math just works out better. Adjusted EPS guidance was increased to a range of $2.06 to $2.19.
Okay, so despite management's confidence, there are some big external risks looming, especially around the consumer.
Oh, for sure. Analysts at places like Wells Fargo and Morgan Stanley are all highlighting the same things: intense margin pressure from that digital mix shift, and just fierce competition from Amazon, Walmart, and Costco.
But the most immediate risk is tied to federal assistance. Yeah.
Absolutely. The biggest near-term risk is the status of the SNAP program. There's a lot of concern about the potential exhaustion of those benefits around November 1st. We're talking about 42 million recipients who spend about $9.2 billion a month at grocers.
So any interruption there is a massive immediate headwind for the whole sector.
The massive headwind.
And we can't ignore the lingering and expensive litigation from the terminated merger.
No, ACI is still very exposed there. The lawsuit against Kroger, where they're seeking that $600 million termination fee plus damages, is moving forward. Trial is set for October 2026. And on top of that, they're managing other significant legal risks from the False Claims Act and various opioid lawsuits. The FCA damages alone could be over $100 million before you even get to penalties. These are serious legal anchors.
So if we synthesize all of this, management's confidence really seems to hinge on two things: visible growth from digital and pharmacy, and a clear path to leveraging SG&A through those big productivity gains. They're essentially telling the market they expect to get back to their long-term growth algorithm, where EBITDA growth outpaces sales growth sometime in fiscal 2026.
That is the entire narrative they are selling right now. ACI is leveraging these low-margin, high-volume segments to grab customers, and they're aggressively returning capital, betting that their standalone value is just deeply underappreciated by the market.
So here's a final thought to chew on. ACI is betting heavily on these high-growth, low-margin segments, and they're relying on higher margins from private label products to offset it all. If they actually hit their goal of boosting own brand penetration to 30% while also absorbing all this pharmacy growth, can productivity initiatives and vendor funding truly fully neutralize those structural margin headwinds and deliver the growth they're projecting for 2026.
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research. Mindful Markets, Measurable Meaning.